Did you know that a shoebox full of receipts under your bed could actually land you with a £3,000 fine from HMRC? Seriously. And with some massive tax changes just around the corner in 2026, knowing exactly how long you need to keep your records has never, ever been more important.
Let's be honest, we've all got one, haven't we? That shoebox, maybe it's a carrier bag, just overflowing with crumpled receipts and bank statements. For so many of us, it's a real source of dread. But is it a necessary evil? And the big question is, for how long do we really have to keep it?
Well, to cut through all of that confusion, we're using guidance that comes straight from the expert tax advisors over at My Tax Accountant. These are the folks who specialize in turning that shoebox chaos into clear, simple advice that makes sure you're always on the right side of HMRC.
So, here's what we're going to cover. We'll start with why good records are so vital in the first place. Then we'll get into the golden rules of timing and some of those special cases that can really catch you out. We'll also look at the massive digital switch happening in 2026, how far back HMRC can actually investigate, and don't worry, we'll finish with a simple action plan you can start using today.
Right. Let's talk about that shoebox. It is so tempting to just see it as a chore, isn't it? Something to deal with once a year and then shove back under the bed. But ignoring it isn't just messy, it can be incredibly costly. Getting your records right is absolutely fundamental to your financial health.
You see, keeping accurate records is crucial for three big reasons. First, compliance. It's just the law. Second, it makes you audit ready. If HMRC ever does come knocking, having organized records makes the whole process so much less stressful. And third, it's a powerful tool for you to track your own financial journey and make much smarter decisions.
Okay, let's get right to the heart of it. Timing. There are two core rules here, and which one applies to you depends entirely on how you earn your money. Let's make this simple.
So you basically fall into one of two camps. Either you're in the first column, employed, where most of your income is from a salary or a pension, or you're in the second column, you're self-employed, a business owner, or maybe a landlord. And the rules for these two groups are completely different.
Right. If you're employed and you don't run a business on the side, the rule is pretty straightforward. You just need to keep your records for at least 22 months from the end of the tax year. So, for example, for the 2024-25 tax year, you'd need to hang on to those records until at least the end of January 2027. Simple enough.
But now for all you self-employed people, landlords, and business owners, you need to pay close attention here. This is where the timeline gets way, way longer. And honestly, this catches a lot of people out. You have to keep your records for a full 5 years after the January 31st submission deadline. So for that same 2024-25 tax year, you're keeping records all the way until January 2031. That is a huge difference.
And here is a crucial expert tip for you. If you happen to file your tax return late, the whole clock changes. The countdown doesn't start from the end of the tax year anymore. Instead, you have to keep your records for at least 15 months from the date you actually sent that late return. It's almost like a hidden penalty for being late.
Okay, so we've got the 22-month rule and the 5-year rule. But, life isn't always that neat and tidy. What about situations that don't fit into those boxes? Well, there are several really important special cases where you need to hold on to your records for even longer.
We're talking about things like selling a major asset, running a VAT-registered or a limited company, dealing with inheritance tax, or if HMRC is actually looking into your affairs. Let's just zoom in on one of the most common ones, capital gains tax.
So ask yourself this. Have you recently sold, or are you maybe thinking about selling a second property, or a portfolio of shares, maybe even a valuable antique? If the answer is yes, then the standard rules we just talked about, they don't apply to the paperwork for that sale.
For capital gains tax, the rule is you have to keep everything for at least 6 years. And listen, this is really important. It's not just about the sale price. The crucial part is keeping records of the original purchase price and, critically, any money you spend improving the asset. Like building an extension on a property. Without those receipts, you can't prove your costs, and you could end up paying way more tax than you need to.
Now, everything we've talked about is building towards this major tipping point for UK taxpayers. And seriously, stay with me here. This next point is going to affect nearly every single small business and landlord in the country. We're talking about making tax digital.
This is a fundamental change to the system. From April 2026, the whole era of the single annual self-assessment tax return, it's ending for millions of people. The entire system is shifting to a continuous digital process.
This isn't happening all at once. It's being rolled out in phases based on your income. It all kicks off in April 2026 for anyone with a combined self-employment or property income over £50,000. A year later, it expands to those earning over $30,000, with more expansions planned after that.
So, what does this new world actually look like? Well, first, all your records have to be digital using approved software. That shoebox under the bed, it's officially useless. Second, you'll send a summary update to HMRC every single quarter. And third, you'll submit one final declaration at the end of the year. Basically, tax is becoming an all-year-round activity, not a once-a-year panic. Okay, now we come to the really sharp end of why all this matters so much. What happens if things go wrong? How far back can HMRC really dig into your finances? You'll definitely want to hear this part because it really highlights the serious risks of getting this wrong.
Because here's the thing, the time limits for an investigation depend entirely on what HMRC thinks has happened. It's a sliding scale of risk, and it's based completely on your behavior and, you guessed it, the quality of your records.
So let's start with the baseline. For most routine checks, where HMRC has no reason to suspect any funny business, they have a 4-year window to open an inquiry. That's the standard time limit.
However, if HMRC believes you've been careless, that window immediately extends to 6 years. Now, careless doesn't mean you're a criminal, it just means you made a big mistake because you didn't take reasonable care. Think of a cafe owner in Manchester who gets their expenses wrong, or a contractor who just forgets to declare a one-off job. It wasn't deliberate, but it was an avoidable mistake.
From there, we take a massive leap. If the investigation involves anything offshore, we're talking undeclared income from a foreign bank account, for example, the time limit jumps dramatically to 12 years. HMRC has a very, very long reach when it comes to international stuff.
And finally, we get to the top of the pyramid, the most serious category. If HMRC suspects deliberate behavior, meaning you knowingly misled them or tried to hide income, they can go back a staggering 20 years. Just think about that for a second. That's 2 decades of your financial life under a microscope. This is exactly why keeping good records is just not negotiable.
And on top of having to pay any unpaid tax and interest, there are specific penalties just for failing to keep proper records in the first place. This can be up to £3,000 for each time you fail to do it. That just shows how serious the HMRC takes this stuff.
Right. I know we've covered the rules, the risks, and the huge changes coming. It might feel like a lot. But the good news is, getting this right is actually pretty straightforward if you have a clear plan. So let's break this down into a simple action plan you can use.
First up, know your timeline. Figure out if you're in the 22-month or the 5-year camp. That is your starting point. Second, go digital now. Seriously, don't wait for the MTD deadline to force you. Start using software or apps today. Third, flag any of the special cases, a property sale, a new company. And remember the golden rule, when in doubt, don't throw it out. And finally, if you're even the slightest bit unsure, just get some professional advice. A good tax expert will save you time, stress, and almost certainly money.
Now, before we finish, it is absolutely crucial to say that all this information is for general guidance only. It is not a substitute for professional advice that's tailored to your specific situation. To make sure you're fully compliant, we strongly recommend you talk to an expert. You can get in touch with the team at My Tax Accountant directly. Their phone number is 0208-570-8531, and the email is info@mytaxaccountant.co.uk. For a more detailed look, you can read their full guide on this very topic on their blog. And for more simple breakdowns of tricky topics like this, make sure you subscribe.